session in providing solutions for technical accounting issues and preparing publications for emerging accounting issues. He has extensive experience in implementation of new accounting standards and is specialized in IFRS 16. And also, he served as a head of finance for a private company owned by a well-known group in Sri Lanka. Beyond his role, Mr. Chandrasoma has distinguished himself as a speaker at IFRS workshops organized by CA Sri Lanka. His commitment to advancing technical accounting skills has had a lasting impact across the accounting industry. Today, we have valuable opportunity to benefit from Mr. Chandrasoma's insight as he leads us through this webinar. Please join me in warmly welcoming him. Sir, we are eager to learn from your knowledge and experience. Over to you, sir.
Okay. Hope you can hear me. Can someone give a thumbs up if you can hear me?
Yeah, we can hear you, sir.
Yeah, thanks. Okay, thank you very much for detailed introduction about me. And first of all, good evening, everyone. I know I got to know from the university, one of your lecture, that there are participants from different departments. So you have at least some level of understanding on financial reporting. So you might have basic understanding to the advanced level of understanding. For everyone's benefits, I will try to explain key concept in SLFRS 9, which is called IFRS 9. There's no difference between these two standards. So I will talk to them with my practical example as much as I can. Right. First, let's move to the first content of the day. I am going to discuss today 4 subtopics under IFRS 9. First, I will talk through scope and definition because it is very important to know about the scope of the standard before applying any accounting standards. You have that scope section. Some are getting excluded from the standard. So it is worth to discuss about scope, and also definition of the financial instrument. I will talk through under that topic. Then I will move to the classification. It is very important subtopic in this session. So if you do not get classification correct, then your all accounting will be incorrect afterwards. So you need to get classification correct in first place. So then I will move to the recognition and measurement section. And finally, I will talk about impairment, bit on impairment. I'm not going to discuss in detail about impairment because it is very complex area when you come to the calculation of it. But I will discuss the theory behind impairment under IFRS 9. Right. First, let's move to the scope and definition. So these are the items that exclude from IFRS 9. First, interest in subsidiaries, associate and joint venture, employer's right and obligation under employee benefit plans, LKS 19, and share-based payment transaction deals with SLFRS 2, and right and obligation under insurance contracts, SLFRS 4. Now it was changed to SLFRS 17. I think in Sri Lanka it is not still effective. It will be effective from 2016 onwards, but it is effective from some other countries, including in Ireland, IFRS 17, but still SLFRS 4 in Sri Lanka. And then right and obligation with certain exemption under SLFRS 16, and also some other rights and obligation under SLFRS 15. So these items are excluded from IFRS 9. Before applying the accounting from under IFRS 9, it's worth to have a look at scope section to see whether your item is covered under IFRS 9. Now let's see the difference definitions. Find what is financial instrument. So financial instrument is a contract that gives rise to both a financial asset of one entity and a financial liability or equity instrument of another entity. Let's take example. Simple example is cash. When you deposit cash in the bank, for you, it is a financial asset. And for the bank, it is a financial liability because bank has to pay back to you when you ask that money. Other common example is trade receivable and trade payable. When company sells good under credit terms, then there's a receivable. There's a right for the company collect the cash in future from the company who brought it, which is called trade receivable. And to the company who brought the goods, so they have contractual liability to pay the cash back to the company that they brought the goods. So for them, it is a trade payable. So it is a common financial instrument practically. And other type of financial instrument is investment. Let's say if you buy shares of another company, subject to it is not under the scope exclusion. So for example, if you buy shares more than 50% of the company, you get the control and you might apply consolidation accounting standard. So scope audit. But this is simple investment. Let's say 5% of the investment, you acquire the share of another company. Then it is a financial asset to the company who acquires shares, and it will be an equity instrument to the who issued shares. So those are example for financial instruments. So what are the financial assets? I explained in previous slides. Cash will be a financial asset and equity instrument of another entity, and also contractual right to receive cash or another financial asset. As I explained, trade receivable is a financial instrument, and sometimes certain contracts that will be settled in entity or equity instruments may be a financial asset. What is financial liability? Financial liability is a opposite side of the financial asset. So anything, as I explained, trade receivable for the it will be a financial asset. Opposite side, it is a trade payable, and also some contracts that we settle in entity owned equity instrument will be a financial liability. So there again, you have separate accounting standard for from the issuer side to see whether it is liability or equity, LKS 32. But in this standard, we are talking about only from the holder side. So if you settle your liability from your variable number of equity instruments, so it will be a financial liability. LKS 32 deals with that equity and liability classifications. Right. From equity instrument again, it will be a financial instrument from the holder side, but not from the issuer side. From issuer side, it is a equity. So equity instruments are basically residual interest. So all of the equity instruments are getting residual interest of the company. They get all the one from total assets. When we deduct all the liabilities, what is remaining is owned by the equity instrument holders. So again, as I mentioned earlier, equity liability classification deals with LKS 32 from the issuer side, but from the investor side, holder side, we cover that in the IFRS 9. So with that knowledge, we'll move on to the classification section. This is the most important section in this standard, in my view, because as I mentioned earlier, if you do not get classification right, whole accounting will be wrong. So classification will drive your accounting afterwards. For your easy reference, I pull out one of listed company financial statements, one of bank, Ceylon Bank financial statements, and I strip out their primary financial statements, balance sheet, P&L, and other comprehensive income. to show you how practically you classify these financial instrument in the financial statements, because I am going to talk through some terminology in the accounting standards, accounting terminology. You might not be very familiar with them, but when you see these in the financial statements of the actual company, so you will have some idea how we are going to present in company's actual financial statements. So this is a Ceylon Bank annual report, balance sheet extract. Uh, Left hand side it shows assets of the bank. I have highlighted in yellow the accounting terminologies I'm going to discuss today, which is coming under financial instrument accounting standard. First one, financial asset recognized through profit or loss, financial asset at amortized cost. Then third one, financial asset measured at fair value through other comprehensive income. These are the three main categories of the financial asset. Moving on to liability side, right hand side, you will see financial liabilities at amortized cost. That's how they show in their balance sheet of these financial instruments. Then I will move to the next slide. Here, this is extract from income statement of the bank. So this is just to show you impairment that I will be discussing in last topic. So they charge impairment on their loan portfolio. They recorded here that in the income statements. Then I will show you the other comprehensive income. This is another primary financial statements. So they have two categories in other comprehensive income. The first category up is that items that may be reclassified to profit or loss. So there you have net gain on investment in debt instrument measured at fair value through other comprehensive income. So you saw that there was debt instrument measured at fair value through other comprehensive income on the balance sheet. So difference in the fair value is recorded in other comprehensive income. So fair value changes basically recorded in other comprehensive income here. Then and down below they have items that never reclassified to profit or loss. So they are fair value changes in equity instrument recognized or classified as other comprehensive income. So don't worry about, I'm talking about a lot of terminologies, but here are the here are how you present them in balance sheet, income statement, and other comprehensive income. We'll discuss theory now. So back to IFRS 9. As I mentioned before, in IFRS 9, there are three categories of financial assets. They are financial assets or a financial instrument or measured at subsequently measured at amortized cost, financial asset subsequently measured at fair value through other comprehensive income, and financial asset subsequently measured at fair value through profit or loss account. Remember these three categories. This is very important. Any financial asset should be categorized under one of these: amortized cost, fair value through other comprehensive income, fair value through profit or loss. On right hand side, it shows the rule drives this classification. So it is basically main on two tests. One is SPPI test, other one is business model test. So I will discuss those business model test and SPPI test in detail in later slides. But remember the classification, the rules over the classification. So I will explain that very simple manner from a decision tree that I have put in the next slide. So this is the decision tree that reflects the rules that I showed you in previous slide. Classification of the debt instrument. How you get into those three categories that I mentioned before: fair value through profit or loss, fair value through OCI, or amortized cost category. First, we look at SPPI test. So SPPI test, we are looking at here characteristics of the contractual cash flows, whether cash flows represent solely payment of principal and interest. For example, normal loan, plain vanilla loan issued by the bank. So bank lent to the borrowers. So there you have two components, interest component and the capital components. So borrower should pay back that installment wise to the bank. So from bank point of view, it is a financial asset. So they are keeping it, they are expecting solely interest and the principal payment from the customer. Then that meet SPPI criteria. So that is the SPPI. So if the SPPI meets, if the SPPI doesn't meet, you will go to fair value through profit or loss classification. So first thing is look at SPPI. If that test fail, you should classify that financial instrument under fair value through profit or loss account. Okay, let's move to the right-hand side. If the SPPI test pass, if the answer is yes, we look at the business model. What's the business model of the company? Are they going to hold that instrument until maturity of the financial instrument? So until maturity of the loan. So let's say same example, let's take so loan will have 5-year terms. So it will be last installment will be paid in, let's say, 2030. So bank keep that loan until maturity to collect the cash flow from the customer. So your business model is to hold that instrument, hold that loan until maturity. Then you go to the bottom right hand blue box, amortized cost category. You will be classified that as a amortized cost, subsequently measured at amortized cost. Right. Now, let's say your business model is not to hold that instrument, not to hold that loan until maturity. It's second decision. So it's to collect contractual cash flow and selling it. So remember, I forgot to mention this earlier. Business model test you do on overall portfolio level, not from instrument by instrument basis. So here in second decision, second business model, you might keep financial asset or a instrument to collect the contractual cash flow, and also you might sell it to achieve your objective, business objective. So you have both holding it to collect and also selling it. In that case, you get into the fair value through OCI financial instrument category. So let's say your business model, none of these. It's not to hold to collect the cash flow, it's not holding and selling it. Then you go to the, again, fair value through profit or loss category. So that's the decision rule. So you keep remember this. These rules governs or drives your classification. First, we look at SPPI test. If SPPI test fail, you instead go down to the fair value through fair value through profit or loss classification. If SPPI test pass, you go to business model test. If the business model is to hold the instrument until collection, until maturity, then you get into the amortized cost classification. If your business model is to, if your objective in the business model achieving both collecting and selling the financial instrument or financial asset, then you get into the fair value through OCI classification. So if both no, again you go to the fair value through profit or loss classification category. Hope you understood the rules over classification of financial asset. And then now let's move to the business model assessment. So how you do this assessment? So there are 3 business model. In decision 3, I discussed held to collect, held both to collect and sell, and residual categories other business model. In held to collect business model, as I mentioned, you keep the financial instrument or keep that financial asset until maturity and you collect the money. So there you are looking at basically the objective is to collect. So you are measuring the performance of the particular business model based on the collections. So basically loan portfolios of that. bank, normal bank. So they are measuring the performance through how you collect money from the customers, borrowers. So that is held to collect business model. So those are classified. Oh, they are come to the held to collect business model. Then you can get to the amortized cost financial instrument classification category. Remember here, that doesn't mean like if you sell some financial instrument then and there, so incidental. So that doesn't mean you can get into the held to collect contractual cash flow. You can sell it, but it shouldn't be more frequent sale. So you need to look at how frequent you are selling that, or what is the reason for selling it. I will get the bond portfolio example. In the bank, it is very common. They buy treasury bonds from the government. Treasury bond is kind of asset or financial instrument that government issued to collect the money or finance their expenditure. So bank buy those bonds, and bank will get coupon interest. They pay coupon interest periodically, normally 6 month times. So they get coupon interest, and on maturity of the bond, let's say if it is a 5-year bond, after 5 years they get the principal back to the bank. Government pay back the principal to the bank. So those are the bonds. So bank has such big portfolio. So if they are keeping the bonds until collection, it's a held to collect model. But in the middle, or if they feel that okay, government is going to default it future, so they are going to, there's a credit deterioration, they might sell it. So that doesn't mean you cannot get to held to collect contractual cash model. So you need to look at past business model, past transactions, see whether how frequent you were selling it. So if it is incidental to the business model, that is fine. So you can still get to the held to collect contractual cash flow business model. Now let's move to the held to collect and sell business model. Here we are looking at what is your objective. Is that your objective is to collect as well as sell the financial instrument. For example, same example, bond portfolio. The performance of the bond, the portfolio manager is measured by, evaluated by the how you get maximum return from that portfolio. So he take decisions, day-to-day decision, whether they are keeping that asset until maturity, or whether you are going to sell it to the market and realize the return and invest that money back to another financial instrument where you get maximum return. So it's both. Sometimes you might keep it until maturity, sometimes you might sell it in the middle to maximize your return. So that business model is held to collect and sell business model. The residual category is other business model. Right. Before moving to the, I have this question on business model. So before moving to that, sorry, I think I should go back. Do you have any questions on business model before going to the question? So I'm going to test whether you understood a business model assessment or not. If you have any question, you can clarify that now, and then we will move to the two questions to clarify it more. Okay. Now let's, it seems you do not have questions. So that means you understood the business model assessment very well. Let's move to the question here. This company, Lila Tech, has a business model that involves selling trade receivable they originate to securitization vehicle, entity S. So basically, Lila Tech is a company, their business model is to sell their trade receivable to another vehicle, special purpose vehicle, to S. And once they sell it, they de-recognize trade receivable from their financial statements, entity financial statements. And from entity who brought entity S, what they do is they issue notes to the note holders and get money from the investor, and they pay to the Lila Tech to buy that trade receivable. So again, S what they do is collect the contractual cash flow from the receivable and passes them to the investor in the notes. So S collect the receivable from the original the borrowers and pass that collection to the investor. The question is here, before that, Lilatech consolidate S. So Lilatech is the company who sold the sales, they are receivable to S, but S is a subsidiary. They consolidate that as subsidiary to their financial statements. So what is their business model? Are the trade receivable held to collect business model? We need to look at two aspects. One is from consolidated level, both together, Lilatech and the S, when they prepare the financial statements as a one entity, as a consolidated group entity, and also from the individual level, Lilatech separate financial statement levels. What do you think? So let's look at the answer. From consolidated point of view, you look at that S subsidiary S and Lilatech as a one entity. So they do not recognize the receivable from the consolidated financial statements. So therefore, your model, your objective is to collect money and pass it to the note holders. So you are getting into the held to collect business model. But if you move to the separate financial statements, entity level, only Lilatech company level, their objective is selling the receivable and realize that cash. So this is very common in Ireland. Actually, there are the banks basically, they sell their loan portfolio to securitization vehicles, and they realize money offhand. Then they can give more borrowings to other borrowers. So it's their business objective is to sell their portfolio. They sell their receivable to another entity, and therefore they are not getting into held to collect cash flow model. Right. Now let's move on to the second question. So here, Lilatech anticipate capital expenditure in few years. So they invest its excess cash in long-term investment so that they can fund the expenditure when the need arise. So many of the investments have contractual maturities that exceed Lilatech's anticipated investment period. Investments are held to collect the contractual cash flow, but when opportunity arises, investments are sold to reinvest the cash in the investment with a higher return. The manager responsible for the portfolio are remunerated based on the overall return generated by the portfolio. So in this example, they are anticipating capital expenditure in future, but since they have excess cash now, they invest that in other short-term and long-term investments. So the portfolio, but the overall performance of the portfolio is measured based on the total return they earn from out of that portfolio. So what portfolio manager does is when he see the opportunity, he sell that investment and reinvest it into the another investment that he can get high return out of it. So that's the business model in this company. So what do you think? So in what business model are the investment held? Is that held to collect business model, or is that held to collect and sell business model? What do you think? Can someone unmute and answer? So here I mentioned three business model: held to collect business model, held to collect and sell business model, and other business model. So held to collect business model, you keep the instrument or financial asset until maturity, but held to collect and sell business model, you keep the financial instrument to collect, but when you see opportunity, when you see you can get higher return, you sell it to the market and you reinvest that money in another financial instrument. So this business model is that held to collect business model, or is that held to collect and sell business model, or other business model? What do you think? Can someone answer, because it's an easy question, easy example from the business model? Then I can move on. Otherwise, I will go back to the previous slide and I will explain again. Okay, I think chat we can see. Yeah. One student has answered collect and sell. Any other answers? Yeah, thanks. Yeah, that is held to collect and sell, because they are taking decision ongoing basis, whether you are keeping that instrument to collect the cash flow until maturity, or you are going to sell it in the middle when there's opportunity. So it's a held to collect and sell business model. Right. Now we discussed business model assessment. Now let's look at SPPI criteria. There's the other test you perform before classification of the financial instrument. So here we look at, as I explained, characteristics of the contractual cash flow, whether it is solely payment of principal and interest. So it should be, to meet the SPPI criteria, it should be consistent with basic lending arrangement. Generally, principal, the loan amount, or for example, loan, you recognize that on initial recognition at fair value. If it is a bank loan, when bank lent money to the customer, the amount they lent is the fair value, basically principal amount they recognize initially. And in addition to the principal amount, they charge interest, you know that. So interest you charge to compensate bank for time value of money, because you are lending money now. For example, let's say 1 million you are lending now, but you are getting that back after periodically you are getting back over the 5 years, over the 10 years. So you forego some, forego the time value of money. So therefore you are charging interest. So therefore interest should reflect, might reflect, or it should be a compensation for time value of money, and also maybe credit risk. Let's say that whoever borrowed might default that repayment. So the bank might face to the credit risk. They might incur the losses. So to compensate that they add small margin to the interest to cover that credit risk. And also they have administrative cost. So bank should run, they should cover that administrative cost. They add some margin to cover that. And finally, they will add profit margin. So all together, you get the interest component to the loan. So this is in line with the basic lending arrangement. Let's say bank charge, so this interest is linked to the share price index or commodity price index. If the commodity price index go up, your interest will go up. If the commodity price index go down, or share price index go down, your interest will go down. In that case, you get another exposure. It's not in line with the basic lending arrangement. You are getting exposure to other aspects, so the share price index and the commodity price index. In that case, it's not solely payment of principal and interest. You are getting another exposure. You do not meet SPPI criteria. Right. Again, I have put that decision tree because this is very important. And I put this again due to two reasons. One is it is important to refresh about how you get into the final categories of the financial instruments classifications. And also I need to explain that fair value through P&L designation option here. So just to refresh you, now you know what is SPPI, what is business model. So SPPI is solely payment of principal and interest. So if it is yes, you go to the business model assessment. If your business model assessment, or if your business model objective is to collect the contractual cash flow, then you go to amortized cost. If your business model is to collect and sell, then you will go to the fair value through OCI classification. If it is none of these business model, then we go to the fair value through profit or loss classification. And also, if you fail this PPI test, you go straight down to the fair value through profit or loss classification. One thing here, you still, even you get to this amortized cost classification or fair value through OCI classification, you can designate that instrument as fair value through profit or loss. How you can do it? You can do it in, so we'll discuss that in here. Even you get to that those classification, you can measure that at fair value through profit or loss. That's the mean of designation. So it can be done at the time of initial recognition, and you cannot reverse that afterwards. And you can do that in a situation where you have accounting mismatch. For example, let's say there's a link liability. Liability is measured at fair value. In that case, linked asset, you can classify or designate it at fair value through profit or loss if you get into, even you get into other classifications. So that is the designation option you have in the standard. Right, now we discussed classification of financial asset, 3 categories. Now we are in classification of financial liabilities. Financial liabilities, we have 2 classification, fair value through profit or loss classification and amortized cost classification. If the financial liability is held for trading, or if it is a derivative, or if you designated it initially, then you measured it at fair value through profit or loss. All other financial liabilities are measured at amortized cost. Again, you have designated designation option here. So when you can designate financial liabilities at fair value through profit or loss, even though it is classified as amortized cost at the initial recognition, or you can designate that fair value financial liability as fair value through profit or loss. You can do it when, again, if it avoid the accounting mismatch. Back to my previous example, if the asset is managed on fair value basis, liability also you can designate it at to measure it at fair value through profit or loss. And if it is managed at fair value basis, if your liability is managed at fair value basis, you can designate it. And also if it contains separable embedded derivative, so entire hybrid contract might be classified as or designated at fair value through profit or loss account. That's the classification of financial liabilities. Okay, we discussed classification of financial asset, 3 categories: fair value through, amortized cost, fair value through P&L, fair value through OCI. Then we discussed classification of financial liability. We have 2 categories: fair value through profit or loss, amortized cost. Now we are back to classification of investment in equity instrument. Remember, this is not from the issuer side. This is from the holder side. From issuer side, it deals with LKS 32, equity and liability classification. From the holder side, when you invest or when you buy the shares, that's a classic example. Generally, you measure those instruments, so investment in equity instrument at fair value through profit or loss. So that's the default classification. But in the standard, you have, again, OCI option. If you want, you can classify it as a other comprehensive income. So any changes will go to the OCI in that case. So that's again irreversible option. So you can do at first time and afterwards you can reverse that. Okay, now classification is done. If you have any questions, happy to answer on classifications before moving to the reclassification. Just raise your hand if you have any questions. I'm happy to clarify it again if you did not understand classification. Now this is reclassification. Once you reclassified initially, you can reclassify your financial asset if your business model get changed. But remember, business model cannot be changed frequently. So it should be very rare circumstances. You should expect significant changes in your operation to change your business model. remember, we discussed business model assessment. Based on that, you do the classification. So if your business model change subsequently, you can reclassify your financial asset from one category to another category. And reclassification of financial liabilities are not allowed, not permitted in the standard. So this is the end of that session. So classification session subtopic. So key points to remember: classification of financial assets depends, or we have three categories: subsequently measured at amortized cost, fair value through OCI, or fair value through profit or loss. And then financial liabilities classified as subsequently measured at amortized cost or fair value through profit or loss. What drives the classification of financial assets? There are two factors you need to look at, two tests. One is SPPI test, other one is business model test. Based on these two tests, you do the classification of the financial assets. Right now, I'm going to move to recognition and measurement sections. Okay. So how you, now we look at the classifications. Now how you recognize it. So when you recognize it, so you recognize this financial instrument in your balance sheet, as you saw in your in the Ceylon Bank annual report, financial statement of financial position. When you are party to the contract of the financial instrument, you should recognize it in your statement of financial position. So how you measure initially? So far I discussed so classification based on the subsequent measurement, but how you measure the initially? So how you do that initial measurement? So generally, all the financial instruments initially measured at fair value, but if it is items not measured at fair value through profit or loss, then you do the adjustment to transaction cost, plus or minus the transaction cost. For example, loans and borrowings. So if you have the loans, or if you lend or you borrow the loan, you have the liability, and the amount you received normally is the fair value. That is the initial recognition. But if you incur any transaction cost when obtaining the loan, for example, if you pay any broker fee, agent fee, or any lawyer fee, any advisor fee, then you can deduct that charge from the loan liability. You will not charge that to the P&L. So that is the fair value plus or minus transaction cost. But if the instrument is measured at fair value, any transaction cost will charge to the P&L. You will not deduct or do any adjustment to the financial instruments. So for example, loan, if loan is measured at fair value, then any cost or transaction cost will not be charged to the P&L. It will be, sorry, will charge to P&L. It will not deduct from the borrowings. So that is the initial measurement. There's a special rule for the trade receivable. You recognize the trade receivable at transaction price as defined in IFRS 15, SLFRS 15. So it's basically the consideration you are entitled to get in. So that is the transaction price. So trade receivable without significant finance component is measured at transaction price. Other all financial instrument measured at fair value. But if the instrument is not categorized at fair value through profit or loss, then you can do the adjustment to transaction cost to the initial fair value measurement. Okay, this is another rule. Sometimes at the initial, normally the fair value at the initial recognition is the fair value is the transaction price. What you paid or what you received, that is the transaction price. That is the fair value initially. But some situations, your fair value will be different to the transaction price. For example, if you get interest-free loan, basically this happens in between intercompanies. If you get interest-free loan from the parent company or any other subsidiary, it is not the fair value, because we will not get loan at interest free from the bank. So therefore, it is not the fair value. In that case, you need to do the adjustment at the initial recognition, and that is this rule. Okay, so I discussed initial measurement of the financial instrument, both assets and liabilities. You normally measure that fair value, and if it is not fair value through profit or loss classified asset or liability, then you do the plus or minus transaction cost adjustment. Now we are here subsequent measurement of financial assets. This is what I discussed in classification. Based on subsequent measurement, you classified those financial assets under three categories mainly: amortized cost, fair value through OCI, fair value through profit or loss classification. So here we have fair value through OCI split out for two subcategories: debt instrument measured at fair value through OCI, equity instrument measured at fair value through OCI, because the recognition in P&L and OCI different for between these two instrument, debt and equity. But generally, commonly you have three categories. Debt instrument measured at amortized cost, all the interest income, any expected credit loss, any gain or losses, FX gain or losses we recognize in P&L, and there's no anything goes to OCI. Then debt investment measured at fair value through OCI. So it is a debt investment. So all the items that you recognize as it was amortized cost will go to the P&L. Basically, interest, you charge all the interest income on those debt instrument, ECL, FX gain or loss, all these charged to the P&L, but only fair value change, because it was classified as fair value through OCI. The fair value change of that instrument is charged to other comprehensive income. And another small rule here: when you de-recognize this investment, you reclassify all your what's remaining in the OCI to the P&L. Coming back to the equity investment. So equity investment at OCI, again, fair value change of that equity instrument will go to the OCI, because your classification is fair value through OCI, and any dividend income you get will charge to the P&L. Again, another rule here: when you de-recognize, let's say when you sell this investment, what is in the OCI will not be reclassified to the P&L. It will be remain in OCI, or will transfer to the retained earning. The last category is fair value through profit or loss. All the changes, you calculate the fair value of that instrument each reporting date, and any changes will recognize in profit or loss account. Nothing goes to the other comprehensive income. So that is the subsequent measurement of financial asset. So by subsequent measurement of financial liabilities, you have two classification: amortized cost classification and fair value through profit or loss classification. Amortized cost classification, nothing goes to the OCI. Everything or gain losses on derecognition or any interest expenses will go to the P&L. Then fair value through P&L items, all the changes will go to the profit or loss account. But I talk about designation thing. If you have designated financial liability, designated as fair value through profit or loss, the own credit risk change, only the own credit risk change that included in the fair value change will charge into the OCI, but all other fair value changes will go to the profit or loss account. So this is the rule over financial liabilities subsequent measurement. So this is the reclassification of financial asset. You can reclassify financial asset at amortized cost to fair value through profit or loss, or OCI, and also fair value through OCI to another financial category or amortized category. Remember, based on the business model change, you can do such reclassification. So here the rules over them, how you measure at the time of reclassification is set out in this slide. So key point to remember here from the measurement and the recognition. So financial instruments, so initially measured at fair value. That's the general norm. But if it is not asset that is classified as fair value through profit or loss, you do the plus or minus of the transaction cost. Then subsequent measurement depends on the classification. So how you classified determine the accounting treatment on subsequent measurement. And amortized cost is measured at effective interest rate, and this debt instrument measured at fair value through OCI. So amount recognized in the P&L is same as what if it was measured at amortized cost. Basically, interest expense, ECL, all these things starts to the P&L, even though debt instrument is classified as fair value through OCI. Only fair value change will go to the other comprehensive income. Finally, equity instrument measured at fair value through OCI. Gain and losses, what you recognize in OCI at the time of derecognition will not or never reclassify to the profit or loss account. So these are the key points that you can remember out of this subsequent measurement and recognition subtopic. Right, now we are into last subtopic, financial instrument and impairment. So here I will touch on ECL, expected credit loss model. So I will not dive into more detail about ECL because it is very complex in how we are going to modeling it and how we are calculating it. But we will discuss the theory behind ECL models. So we have single model for measuring the impairment. That means we apply same principle for all the financial assets to measure the impairment. And here we look at expected loss model. Earlier it was incurred loss model. We are not waiting until loss event occur to make the provision for the financial asset. So we are estimating it in day one and make the provision. For example, earlier it was, I can remember when I do my A-level in 2022, 2002, before 23 years ago, actually, we were providing when I do the calculation. So accounting questions, we get questions, bad debt provisions. We provide for over 365 days debts. If the debts goes before over the 365 days, you make the bad debt provision. So that is the old standard. That is an incurred loss model. So you are waiting until loss event happen. So over 365 days debts. So you might not get that debt. So that is loss event already happened. But under ECL model, new standard, you don't wait until that goes to that extent. On day one, you recognize the provision. That is the expected loss model. And loss allowance recognized. So you basically do not write off the debt for the allowance. You make the allowance. So you make provision kind of things in the on the balance sheet. You deduct that provision from the whatever financial asset or a loan portfolio, loan receivables. So you write off when you know that you are not expecting money from the customer. You reasonably knows that you are not going to get money from the customer. In that case, you can write off. But if not, you do not write off your debt. You make the allowance in the financial statements. So scope is basically you do not provide provision for equity instruments and also in the equity instrument measured at fair value through profit or loss. But you provide the provision ECL for all the assets measured at fair value through OCI and fair value through, amortized cost assets. That is the scope. Remember, you do not provide provision for equity investment in equity instrument and also investments measured at fair value through profit or loss. So there are two approach, initial model, general approach and simplified approach. Under general approach, we look at dual measurement, 12 months ECL and lifetime ECL. 12-month ECL, we are looking at default event that will happen next 12 months, within next 12 months. That doesn't mean the exposure or what is due next 12 months, but default event, the probability of default that happened within next 12 months and make the provision. That is the 12 months ECL. But if there's a significant increase in credit risk, we do the lifetime ECL. What is a significant increase in credit risk? It is, we look at here whether credit risk increase from the initial measurement. For example, if the initial, at the time of initial recognition, you have a grade financial instrument, but when you look at subsequently, it is downgraded to D grade. Let's say it was one category, grade 1 category, now it is grade 5 category. Then there's a significant increase in credit risk. In that case, you do the lifetime ECL. There you are looking at probability of default that can happen over the lifetime of the until lifetime of the instrument. So if it is a 5-year loan, you look at every year probability of default. So lifetime ECL is higher than 12-month ECL. That's the learning point from this slide. So here what I explained, 12 months ECL and a lifetime ECL. So 12 months ECL, we are looking at default events possible within next 12 months after the reporting date. But in lifetime ECL, we are looking at default event over expected life of the financial instrument. So again, measurement of ECL, it should be unbiased probability weighted amount. We are looking at here cash shortfall. So we get the percent value of the cash shortfalls as a provision. So when you are doing it, you need to assess all the economic scenarios. You need to assess probability of default or whether customer will default. You need to do it in different scenarios. What is the probability of doing that? So that is the measurement, whole measurement methodology. And also we are looking at LGD, loss given default. Let's say if the borrower has a collateral, if it is a housing loan, bank can acquire the house and sell the house and realize some cash if the customer defaulted. So your loss will be not 100% of the loan, some extent. So you're looking at loss given default and probability of default, and based on these factors, you make the provision to the exposures. So, and other important information is forward-looking information. So you need to incorporate forward-looking information to your probability of default. You are not just not looking at past events, how that customers or customer portfolio in that segment performed. You need to see current conditions and also future economic scenarios. Let's say if you expect growth in GDP next year, you can expect decrease in probability of default, because then customer will have or might have good ability of repaying if the GDP is going to improve next year. So you expect customers repayment ability also increase because of his income might increase with the GDP increase. That kind of expectation you might made, and you need to incorporate forward-looking information to your probability of default calculation. So that is the requirement in the standard. In simplified approach, you do only the lifetime ECL. There's no 12-month ECL and lifetime ECL in simplified approach. Basically, for trade receivable without significant finance component, you do the simplified approach. But others, lease receivables and trade receivable with significant finance component, you have policy election. You can either apply general approach or simplified approach. So that's the election, policy election you can do. Remember, in simplified approach, you do only lifetime ECL. You do not have dual approach, 12 months ECL and lifetime ECL. So that is the ECL. So key point from this, so we have single expected loss model in IFRS 9. So you apply same principle to all the financial assets, and you have like you need to look in dual approach. You need to look at significant increase in credit risk. So you need to apply the judgment whether credit risk of that asset increase after the initial recognition. Based on that, you do the lifetime ECL, and simplified approach applies to trade receivables. Generally, most of the companies apply simplified approach for the trade receivable and contract assets. So remember, the ECL should be probability weighted amount. So you need to assess all the economic possible outcome scenarios, and probability should be estimated when you are making the ECL. And also forward-looking information should be incorporated to the PDF, probability of default. So those are the key points from ECL. I know it is very complex accounting standards. I discussed now all 4 topics: scope, and then classification, initial recognition, and subsequent measurement, and finally ECL. So it is not possible to grab everything within 1 hour, but I hope you learn at least few out of today's session. So if you have any questions, you can ask. You are free to ask now, or you can direct me, or can send me email. Even I am happy to help you if you need to clarify anything related to IFRS 9. Thank you very much for joining and listening me. If you have any questions, I'm happy to answer now. So even in chat box, you can put if you have any questions, or else we can end the session, Himal.
Yeah, student, if you have any questions, you can ask from our resource person. Yeah. Because actually from this area, we are giving you a question in your question paper. Right? So therefore, if you have any clarification, you can clarify here.
Right, it seems that no questions. And again, thank you very much for joining, and have a nice evening. Yeah. Any questions?
Good evening, everyone. Am I audible?
Yes, I can hear you.
Good evening, everyone. On behalf of Department of Accountancy, University of California, it's my honor to extend my heartfelt gratitude to Mr. Sandun for taking the time to share his valuable knowledge and insight with us today. So we sincerely appreciate your willingness to contribute to our academic development and for being a part of our learning journey. So thank you once again, sir, for your time, your effort, your generous sharing of expertise. Thank you so much.
Thank you very much.